Welcome to the latest episode of Quest for Twice. In this episode, I'm going to cover Emerson. Why? Because it's a very important company. Let me explain. Emerson has a very diverse exposure to many industries because it has two segments. One is automation, the other one is commercial and residential solutions. The chart on the left shows the percentage of sales of Emerson from various sectors it serves. So the bottom three are oil and gas related. It's about 25% of sales in 2020, and that's 9 percentage points less than about 6 years ago. The top are the commercial and residential markets, about 25% sales also. Then in the middle are various industrial sectors. So because of such a diverse exposure to so many industries, Emerson gives a very good view on what's happening globally in various industries. Overall, 64% of sales of Emerson comes from automation, and 36% comes from commercial, residential, and cold chain. Because of such a broad exposure to various industries, it's very difficult for analysts to gauge accurately about the future business of Emerson, and because usually the analysts would be specialized in different industries. For example, oil and gas will be covered by an analyst, and the commercial residential housing markets will be covered by a different analyst. And they are in between, for example, chemical and heavy industry and or light industry. They are all covered by different analysts. So it's very difficult for a single analyst to give an accurate forecast of Emerson's business. As a result, there are opportunities for earning surprises. It's important to point out that Emerson's customers are other businesses, so it's a B2B business model. Its growth is driven by its customers' capex expansion. As a result, it's a bellwether for mid-cycle economic development because usually capex expansion does not happen in early economic cycle because when the economy just comes out of a recession, there is plenty of spare capacity, and the companies usually don't need to expand their production capacities. As a result, they don't need that much new products from Emerson. Given we are early in the new economic cycle after the recession induced by the COVID pandemic, then Emerson is a good play for mid-cycle economic expansion. So let's take a bit midterm view on the investment thesis. The first of all is automation is a long-term trend because it has been proven that automation is a way to increase productivity and reduce the long-term cost of the various business. Additionally, if labor inflation picks up as intended by the Federal Reserve, then that will add additional incentive for companies to add automation to reduce labor cost. Another long-term trend is a reduction in greenhouse gas emissions. Here, Emerson has multiple products that will help the society to reduce carbon footprint. The first one is using heat pump that's powered by electricity to replace a natural gas furnace or um, heating oil furnace, both of which emit more carbons compared to heat pump. If the electricity for heat pump comes from renewable sources. Another driver is low greenhouse gas refrigerants. For example, in the past, the refrigerant in the AC system has a higher global warming potential, and those will be replaced in the near future by low greenhouse gas refrigerants. That will drive a new HVAC system, a new compressor system when the refrigerants change. Another driver is a higher efficiency HVAC system. For example, in a few years, the US in the south will require HVAC system has a SEER rating of 15 instead of a current 12, 13 rating. That will drive also additional HVAC system sales and upgrades. Another driver is electrification of everything. So when industrial systems are electrified, there are more opportunities to automate the control system and increase the market for the Emerson's automation segment. So those are detailed views. Let's take a view from a much higher level. This bar chart on the right shows that the current and the historical greenhouse gas emissions from 2010 and 2019. So in 2010, the global population was 7 billion, and 2019 was 7.8 billion. And the CO2 emission was 30,000 metric tons in 2010 and 10% more in 2019. So that's roughly in line with the global population growth. Then, based on the forecast, based on the current stated policy by various countries to reduce the greenhouse gas emission, and the CO2 emission in 2040 will actually be about flat despite the significant population growth. If the society will reach the sustainable development scenario, it actually need to significantly reduce the CO2 emission, cut it by more than half. So what are the different implications of those two scenarios? Let's look at the stated policy scenario first. The bar chart shows the various primary energy sources. For example, from coal at the bottom, moving up to oil, natural gas, and renewable sources. So for the stated policy scenario, the coal share will be reduced, and the oil will be slightly more, or about the same, and natural gas will be significantly more compared to 2019. Despite the even more significant increase from renewable sources. So for that scenario, Emerson will be okay, given its 25% revenue comes from oil and gas. And it also plays in the other categories, as I mentioned, in the HVAC and industrial automation and control sector. For the sustainable development scenarios, then emissions from oil and gas and coal will have to be reduced significantly. The renewable power generation will be increased even more. And that's actually good for Emerson because to achieve such a significant reduction in greenhouse gas emissions, we will require very large capital investment. For example, investment in making new batteries, and investment in new charging stations, and the investment in new industrial facilities, because all those sectors generate significant greenhouse gas emissions. So Emerson will actually significantly benefit from um, the society achieving sustainable development scenario from the stated policy scenario. And keep in mind that even the stated policy scenario is broadly beneficial to Emerson's business. In February, Emerson gave an update on the global economy. So it's a very informative. Let's look at this chart. At the top, it shows a different type of business. The biggest bubble is the KOB3. That's really maintenance. So what we can see is it doesn't fluctuate that much with the economic cycles. So that's why Emerson still had a pretty strong revenue in last year despite the recession. The KOB2 is the upgrades, and that's on the upswing. And then that can potentially go much higher with the economic cycle progress. And the KOB1 is the new infrastructure. And in February, Emerson views that as at the bottom of the current economic cycle, and it has a long runway ahead of it. So the key message is that Emerson's business will benefit from the following on economic cycle. Emerson also gave a view about the world economy in different regions. So the Asia Pacific is currently in expansion. And Emerson has a significant exposure in that region. It's followed by Middle East and Africa. And Europe is almost out of recession, and Emerson also has a significant exposure to that region. North America recovers the slowest among the globe. However, given the significant vaccine progress in the United States, I expect North America will actually catch up and surpass Europe. The bottom one is also very interesting because it gives Emerson's view on the various global industries. For example, let's look from right to left. The traditional power generation, that's coal and natural gas power generation, is on the way down, and Emerson has a significant exposure there. And life science and transmission and the distribution close to the current cycle peak. Automotive industry is on the way up and not too far away from the peak. And the chemical and the clean fuels are on the way up, and it's going to enter a good cycle above long-term average. And the upstream gas is ahead of upstream oil, which are up ahead of the refinery and the pipeline. So it's interesting to get the view from Emerson because I also invest in pipeline companies. And to me, it's actually good to see that the pipeline companies are not spending capital at this moment because, for example, Energy Transfer is not spending the additional cash on expansion capital. Instead, Energy Transfer is using the free cash flow to pay down debt, and eventually will start to buy back shares or increase the distribution. So that, as a shareholder, I actually like that. So Emerson gives a good intelligence on the various industries I'm interested. Emerson also provided the trailing 3-month order updates. So this graph covers the year-on-year order changes in the last 5 years. So we can see that those are usually cyclic and expands about 4 or 5 years cycle. And what we see in last year is there was a very significant drop-off in new orders, then had a very quick recovery, especially for the commercial and the residential solutions. And even with a very hard housing market, Emerson sees an acceleration again in February and March. That's informative because I also invested in AdCore and will also benefit from the commercial and the residential market. And Emerson gives a good update on what's going on in that market. The Emerson's automation solution orders are still contracting compared to 1 year ago, but it is recovering very nicely. So the trend is on the way up, and that will be reflected in the revenue in the rest of the year. So this is a good leading indicator for Emerson's revenue as well as for the industries Emerson serves. So let's take a look at Emerson's Q2 results. Keep in mind that the Emerson fiscal year ends in September of each year. So for its automation segment, its revenue declined by 2% from 1 year ago. That's actually an improvement compared to 9% decline in Q1. Its EBITDA of automation segment actually increased by 15% compared to 1 year ago. And that's also improvement compared to 9% increase in Q1. And the reason its EBITDA increased despite the slight decline in revenue is because of Emerson cut its cost significantly, and it's benefiting from the cost reduction exercise it went through in the last 2 years. It's a commercial residential solution segment had a slightly increased revenue in Q2 compared to the significant 12% increase in the Q1. But from Q1 to Q2 in this fiscal year, its revenue actually increased. Its EBITDA in Q2 increased 12% year-on-year, compared to in Q1 23% increase year-on-year. But again, it sequentially improved from Q1 to Q2. What's more important is Emerson provided the updated outlook for the fiscal year 2021. So now it forecasts this year the revenue will increase to about 7-8% compared to 6% its guidance in Q1. Its EBITDA margin is also forecast to increase slightly compared to the 22.5% guidance. So as a result, Emerson believes this year its cash from operations will be $150 million more compared to outlook given in Q1. Its capex and the dividend plan for 2021 is 600 million and 1.2 billion. So add those two together is 1.8 billion, and that's significantly less than 3.3 billion. So Emerson will have a lot of surplus cash after paying capex and dividend that can be used to either buy back shares or doing mergers and acquisitions. Both are good to expand the future earnings. So it's interesting to know that Amazon has a fairly high EBITDA margin. For the automation segment, it's 23%, and the commercial residential solution has a 26% EBITDA margin. Its return on invested capital is about 14%. That is why it's good for Amazon to spend the capital organically or in M&A, because those invested capitals earn high returns. Currently, it's a forecast for this year's EBITDA is about $4.1 billion. And given its market cap of $57 billion and the net debt of $6 billion, it has an enterprise value about $63 billion. And the EV over 2021 EBITDA, the ratio is about 15.4, comparing to 14 for its peers in the industrial segment. So given that it has a very high margin and generate a lot of cash, and also has a long-term tailwind from automation and greenhouse gas reduction initiatives taken by the society, I think it's either fairly valued or it's slightly undervalued. So my plan is to buy Emerson during market downturns and Emerson stock price pull back. Thanks for watching another episode of Quest for Twice. Until next time, happy investing.